Welcome into EP Wealth Advisors Informed Investor Market Update. I'm Rob Black. Joining me today, Managing Director of Investments at EP Wealth Advisors, Adam Phillips. We do this weekly. Miss a week or two, tend to, sometimes to blame it on holidays, but typically this is a 52-week endeavor. So it gives us kind of a snapshot, bullet shot, if you will, into the stock market. Let's take a look at where we are year to date. The Dow Jones Industrial Average up 4.3%. That's interesting. Last year was the NASDAQ 100 and the S&P 500 leading the markets. The NASDAQ 100 is up 3.5%, coming in second place. The S&P 500 up 3.1% as we're done through about 5 weeks of the year, roughly, maybe a little bit more. The S&P mid cap up 2.8%, and the Russell 2000 small caps up 2.7%. So they're all doing well. They've all had a pretty good 2023, 2024, exceptional for tech and NASDAQ. But 2025 starting off pretty well, Adam. Does this make your job easier or tougher? And what do you think of these results with the Dow leading the way, followed by the NASDAQ, the S&P, the mid cap, and the Russell 2000?
So far, so good. I'd
Good.
say to an extent it makes my job easier. I never want to complain about positive performance. I think it's really nice to see that we're seeing some broadening out in terms of performance. If we just look, as I often do, underneath the hood, I think it's really interesting that the only sector of the market that's in the red so far this year is information technology, which has really been one of the strongest sectors over the last couple of years. There's a handful of Magnificent Seven companies that have been struggling so far this year. NVIDIA is one that comes to mind. I think after the run that we've seen over the last couple of years, a little bit of a pause is warranted and I think certainly a reasonable thing to expect. So it's nice to see that the rest of the market is really catching up here. I hope and expect that it will continue throughout the course of the year. But what makes my job a little bit tricky this year is that it's just a very difficult policy environment. Because of that, we are likely to see some volatility here as in the weeks and months to come. I think it's just a really difficult environment to navigate, and so because of that, yeah, we're happy to see performance where it is, but we also are buckling in just in case we see volatility come back, which we really haven't seen over the last couple of years.
Let's talk about that. There's a lot of T's in today's headline updates. Tariff talk, Trump talk, inflation, economic data. But let's talk about Trump. Typically, I think, and again, I'm not politically very savvy or smart. I'm 1 inch deep, a mile wide. But typically, politics play a big role on Wall Street in the first 100 days as you figure out the administration. It's a phrase that I didn't really hear until about 20 years ago. The first 100 days of administration kind of set the tone. Volatility has kind of been there, but also Wall Street's kind of brushing off the tariff talk. Um, Thoughts on the first 100 days and a little bit more volatility, a little bit more drama, maybe on Wall Street, expected or not expected?
Yeah, look, we expected the volatility. I'd say we are we're living headline to headline
Yeah.
here, and it's just so hard to really know where we're going. We saw a couple weeks ago the announcement that the tariffs would begin on February 1st for China and Mexico, our two neighbors and major trading partners, tariffs of 25%, and we've seen that those have been postponed. And so the market has kind of breathed a sigh of relief, but we're not out of the woods yet. But maybe for now, rather than shoot first, ask questions later, the market's going to wait and just digest things and see where it all goes, because maybe this is more of the negotiation process. I think it makes things very, very challenging over the near term, but maybe that's why we haven't seen that volatility persist or continue. We've seen that many have actually bought on weakness. And at the same time, we're in earnings season, and so far we can talk about that. But so far, earnings season is going very, very well. But yeah, getting back to the tariffs, it's a tricky environment, and just like we're struggling, the Federal Reserve is struggling, businesses are struggling to really just make sense of where we are and where we're likely to go. We saw over the weekend, just yesterday actually, that President Trump announced that there would be tariffs of 25% on all steel and aluminum imports. So no matter where they're coming from. And so again, just living headline to headline, what this means, I think, we are just in a very fluid environment, and I think really for now, what we're all assuming is that we could see a little bit of a little bit of a hit to growth before those more stimulative policies actually make their way into the economy. Things like easier regulatory environment, tax cuts for corporations, things like that. We think are potential tailwinds for the market, for the economy. But there might be a little bit of pain just that comes before that. So I think that's what we're waiting to see play out.
And it should be also noted that some of those tailwinds might ultimately be headwinds if Trump isn't successful in convincing Congress to cut taxes on corporations and individuals. And just a lot going on with tariff talk, with Trump, with inflation, with economic data. I think we've hit the tariffs pretty well, but stay tuned. To be resolved next week. It seems like it's a not a delay game, but a lot going on. Let's talk a little bit about earnings season. We've seen some companies report and get rewarded. We've seen some companies report and get punished. So I look at that as a stock pickers market. We're not in all things are melting up. We're not in all things are breaking out to new highs. Feels a little bit, although we are at near all-time highs, feels a little bit like a stock pickers market, depending on sectors and individual companies. Thoughts on what we're seeing with earnings?
On the whole, earnings season is going very, very
Okay.
well. So we are tracking at about 15% year-over-year growth so far for the fourth quarter earnings season. That is really, really strong. It would actually be the strongest in over 3 years. So far, so good. Now we still have about 40% of the companies in the S&P 500 that have yet to report. The
Okay.
big ones in NVIDIA, which I believe doesn't report for another couple of weeks or so. So we'll see where that comes in. But on the whole, we're looking at positive earnings growth, strong revenue growth. So things are very good. What we're hearing from managers and it is really interesting. We're seeing a lot of talk about tariffs. They're being mentioned, and I'd say most are mentioning them in the context that it adds to the uncertainty. They don't really know how it's going to factor into to their business and their spending decisions over the next several months, but they are waiting and very anxious to get some clarity on these issues because it is top of mind for them. Like I said, just like it's top of mind for us and for the Fed, we're actually seeing that in terms of the mentions of tariffs, it's the highest that we've seen since 2019. So, even though, yeah, I'd say we're done talking about the specifics around tariffs. It's really front and center, right? But on the whole, yeah, earnings growth is going very, very well, and I think that's so important. Just knowing the strength that we've seen in the market, earnings is the time to really justify these valuations. And so on the whole, we're seeing companies justify them, but those that aren't, they're getting hit. And so I think that is important. It really it tells you that you need to make sure you know what you own and you know why you own it, because this is a stock picker's market for sure.
We're recording this on Monday morning, so the data could change. But as of the start of the morning, only two of the Magnificent Seven stocks were up for the year, with the other five underperforming. And you mentioned the IT sector is the underperforming sector. Um, is that a case of valuations matter in that sector now, whereas maybe lower interest rates, maybe inflation matters in other sectors, but tech is focused on valuation, maybe?
I think that's part of it. We've
Okay.
seen sentiment that has become so stretched. It's still stretched. And so when you have these negative headlines that come through, and it could be DeepSeek a few weeks ago,
Yeah.
it could be earnings that might disappoint in terms of what many investors were hoping to hear. That just leaves you vulnerable to some kind of a pullback. And so I think for a mix of reasons, we've seen that happen. And at the same time, this hasn't flowed through to just a broader market sell-off. This has led to more of a rotation into other sectors of the market, which I
Okay.
think is a really good sign.
Yeah.
And so that's why I think this diversification outside of those mega cap tech, the areas that have been leadership for so long, it's really, really important because the higher these valuations get, the higher these hurdles become to continue to please investors and justify these levels. So yeah, I really think that's what we're seeing here.
It's interesting because the 1990s had a lot of dot-com stocks that exploded on the upside. The 2020s has a lot of AI stocks that are exploding on the upside, but the same phrase comes back to haunt me. I heard a lot of consumers say diversification instead of diversification. Diversification kind of became a bad word, and now we're starting to see the positives of it. Quick thoughts on that, or how the 90s are kind of repeating, or the dot-com era is kind of repeating the AI, and diversification is something we get away from, but in the end, it's home. We always come back to it.
Yeah, well, look, it's diversification is the only free lunch in investing. And we
Interesting.
really, there's going to be periods when you wish that you held a lot more in say NASDAQ companies or those mega cap growth companies, times like last year and the year before, right? But we know that these times these good times don't last forever. And leadership changes. These things go in cycles, and eventually there's a reversion to the mean, and there's a shift towards those areas that have been laggards in a recent period. And so that is why we are focused so heavily on diversification. You want to have some skin in the game, but you don't want to get over your skis here. And so I'm happy, I guess, to see that there's other parts of the market that are performing well, while we're seeing areas within technology struggling. I think this is really this is something that we preach all the time. Stay diversified. There's going to be a time when you are happy that you have this broader exposure, and we expect this to continue. And maybe it's very easy when you start talking about comparisons to the 90s. These are high quality companies. These are profitable companies. They've been the source of profit growth within the S&P 500. And so to an extent, you can justify why they've been leadership for so long. That gap in profitability between say, the Magnificent Seven companies and the rest of the market, the S&P 493, if you will, that gap in year-over-year profit growth is expected to continue narrowing here as the quarters go on. So it's expected to narrow to about 5 or 6% by the end of this year, which means that those Magnificent Seven companies, they're only going to grow profits at about 5 to 6% more on a year-over-year basis than the rest of the market. And so that gap, that reason to maintain such heavy exposure, I think is going to decrease. You're going to see less, less of a reason to really lean into too heavily into those companies because there's going to be other opportunities outside of that. And so not just these initial winners of artificial intelligence. I think we're going to see that, okay, maybe there's going to be a next phase of this. And what is that next phase going to be? It could be, how do you apply it? It could be software companies. It could be other types of companies, even outside of technology, that have found ways to utilize artificial intelligence. And so there's other ways to continue playing this theme as time goes on.
Yeah, a lot going on with the investment policy committee and yourself leading that group. There's productivity gains. There's free cash flow of the big tech companies versus capital expenditures. Wall Street's digesting this all in real time, and we're lucky to have you. Let's move on to the big economic data of last week. We had the jobs data this week. We can't always look backwards. We got to look forwards. We got CPI, and Jerome Powell's kind of stuck in the middle of the past information and the future information. What do you see with that jobs data from Friday? I barely noticed it. I was doing a long weekend, and the CPI this week. What do we need to know?
I think you're not the only one that didn't really notice the jobs data. There really wasn't a ton there, and I think that so much attention has shifted towards inflationary data and talk of tariffs. I think that the jobs numbers are still very, very important, but they've kind of taken the back seat to the other stuff so far. But look, the jobs market is still healthy. We saw that job growth was a little bit lower than expected at just over 140,000 jobs added to the economy in the month of January. But we did see positive revisions to the last 2 months of about 100,000. So that was strong, and so because of that, I think that most just took that and took away that the economy is the jobs market is still in good shape. So that's good. As we shift our attention to this week, we're going to get inflation data. We're going to get CPI, the Consumer Price Index, and PPI, the Producer Price Index, in the middle of the week. So we'll see what that has in store for us. I think a lot of investors are going to be focused on Jerome Powell. He has 2 days of testimony starting tomorrow, Tuesday, and on Wednesday. It's what they used to call the Humphrey Hawkins testimony, part of the Humphrey-Hawkins Act that was passed, and basically said the chairman of the Fed needs to show up and testify before Congress twice a year on monetary policy. It's now called the Monetary Policy Report. And so we'll see what this will be televised. I think a lot of people are going to they love hearing from all Fed speakers, but certainly Chairman Powell. I would expect he's going to just kind of stick to the script of saying we're waiting for disinflationary progress to resume and for inflation to get back towards and start trending towards that 2% goal. It's kind of been hovering. If you look at CPI at around 3% or so, and progress has stalled out a little bit. And if and when he's asked about some of President Trump's policies or tariffs, I think he's just going to say, look, we don't factor that into our decisions. Now, whether that's true or not, he's going to say that they are really just focused on the data and they don't get into the political stuff, and they really try to avoid it. And so that's what I would expect to hear from Jay Powell this week.
Absolutely. And thanks very much, Adam Phillips. He's the managing director of investments at EP Wealth Advisors. I want to tell everyone we have a great website, epwealth.com. At it, you can hit events, you can hit different areas, and you can see seminars, you can see webinars, you can read blogs, all financial data. It's not just the boring economy and investment stuff. It's so much more. So check it out, epwealth.com. That's epwealth.com. Don't forget, talk to your financial team. Always good at the start of the year before tax season kicks in to kind of get an update on where you are. Don't be shy. That's important in the wealth management process. I'm Rob Black for the Informed Investor Market Update with EP Wealth. Good day.